Most retirees spend decades saving and investing, but when retirement finally arrives, the real challenge begins. How do you turn your savings into income without letting taxes eat it alive? Here's the good news. You have far more control over your tax bill in retirement than you did while you were working. By using the right accounts in the right order, Roth, taxable, IRA, charitable tools, and smart deduction strategies, you can dramatically reduce or even eliminate taxes in many retirement years. Today I'm going to show you exactly how to create tax-free income in retirement, using strategies available to every retiree. Not loopholes, not gimmicks, but clear planning tools that shift more money into your pocket and away from the IRS. Before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's get started. When you were working, taxes were mostly out of your control. Your employer paid a salary, your withholding was set, and your tax bracket was tied to your income. But in retirement, you control the timing, source, and structure of most of your income. And that means you can stay in lower tax brackets, prevent Social Security taxation, reduce Medicare IRMAA surcharges, lower future required minimum distributions, and increase what you spend without increasing your tax burden. The key is learning how different accounts interact and how to build income streams that keep your taxable income low while keeping your lifestyle high. Let's break down the core tools next. Roth IRAs, Roth 401ks, and Roth conversions are the backbone of most tax-free retirement strategies because once you meet the age and 5-year rules, withdrawals are 100% tax-free. And Roth withdrawals don't increase your taxable income, don't increase Medicare premiums, don't affect your Social Security taxation, and never trigger required minimum distributions. This makes them incredibly valuable for tax planning. So here's when you'd want to consider using Roth withdrawals. Think of your Roth bucket as the tax control valve for your retirement plan. Use Roth withdrawals in years when other income's high. Use Roth to avoid bumping into a higher tax bracket or to prevent from paying IRMAA surcharges. And use Roth to minimize provisional income so Social Security stays tax-free. The earlier you build this Roth bucket through Roth contributions and early Roth conversions, the more flexibility you'll have in retirement. But ideally, you're not touching your Roth bucket unless it's all you have left. There are other strategic ways to retire with a low tax bill or no tax bill at all with proper planning. The second tool you want to utilize is tax-free income from your taxable brokerage account basis. Most retirees overlook one of the most powerful tools, the cost basis inside their taxable brokerage account. Here's why this matters. When you sell investments in a taxable account, only the gain is taxable. The basis, your original investment amount, comes out tax-free. An example of this would be, let's say you bought an index fund for $100,000 many years ago, and now it's worth $180,000. If you were to sell $40,000 of that index fund, the first roughly $22,000 comes from basis, which is a tax-free distribution, and the remaining almost $18,000 is a capital gain, and that would be taxed at capital gains tax rates. But here's the kicker. Many retirees qualify for 0% long-term capital gains tax rates. In 2025, married couples with taxable income under $96,700 qualify for the 0% capital gains bracket. In 2026, this number jumps to $98,900. And for you single filers following along, just cut those numbers in half, and that is what you have to keep your taxable income under for your gains to be tax-free. And if you've been following my channel for a while now, this is what I call the pseudo Roth account. Because even though you are realizing gains, you can still do so tax-free if done correctly. This allows you to have the same tax treatment on these funds as you find on Roth distributions. Nothing at all. And that means you can sell appreciated assets, realize these gains, and pay zero in federal income tax. Combine that with withdrawal sequencing, and your taxable account can fund years of tax-free income, especially early in retirement before Social Security and required minimum distributions kick in. They can also help you fund your Roth conversions. This is a very underused strategy, and it's one of the easiest ways to create multi-year tax-free windows. If you want a detailed walkthrough on this strategy, please watch our video, How to Retire in the 12% Tax Bracket, which illustrates how to make this scenario a reality for you. Next, let's talk about qualified charitable distributions. If you're 70 and a half or older, qualified charitable distributions allow you to donate up to $108,000 in 2025 or $111,000 in 2026 from your IRA to a qualified charity. Why is this tax-free income though? Well, because qualified charitable distributions count towards your required minimum distribution, they don't show up on your adjusted gross income. They reduce provisional income, so there's less stress on Social Security taxation implications. They reduce your IRMAA surcharge risk, and they replace itemized deductions you may not otherwise qualify for at that point in your life. This makes qualified charitable distributions one of the most powerful charitable planning tools available. Let's go over a brief example. If your RMD is $30,000 and you give $15,000 to a charity each year, doing it directly from your checkbook increases your AGI. But doing it from your IRA as a qualified charitable distribution lowers your taxable income immediately. For charitably inclined investors, QCDs are one of the best forms of tax-free income boosters. At this point, I just want to take a minute break from the video to thank our viewers. We've seen explosive growth on the channel recently, and I wanted to thank each and every one of you for taking some time out of your day to spend it with us. I sincerely enjoy the comments you all leave, the likes you give, and a special thank you to those of you who've subscribed already. You are truly what makes this channel special. Getting to know some of you personally through video calls where you've become clients is even more special. We appreciate your business and look forward to serving you for many, many years to come. So please, if you haven't done so already, subscribe to the channel, throw us a like, or even schedule a call via the link in the description below. I would love nothing more than talking about your situation for 30 minutes and seeing if there's a long-term fit where NAV Wealth can help you reach your goals. Let's jump back into the video. The next strategy involves stacking deductions to create tax-free withdrawal years. Most retirees don't realize they can engineer tax-free years simply by stacking deductions. Here's how deduction stacking works. In some years, you bunch charitable giving, medical expenses, or donor-advised fund contributions to exceed the standard deduction. In those years, you can withdraw from IRAs or convert more to Roth while staying in a low or zero tax bracket. In off years, you take the standard deduction again. So going over this in a brief example, a person with $30,000 of Social Security and $20,000 of deductions may withdraw an additional $20,000 to $40,000 from IRAs while paying little or no tax because their taxable income after deductions remains incredibly low. A few well-timed years of deduction stacking can reduce lifetime taxes by tens of thousands of dollars. You also want to be aware of the enhanced senior deduction that was put into place this year and runs through 2028. For married filers who keep their modified adjusted gross income below $150,000 and single filers who keep it below $75,000, you will receive an additional $6,000 deduction. If you're over the age of 65 and married, that's a standard deduction of nearly $47,000. And for single filers, it's nearly $24,000. This is tax-free money that you can't afford to leave on the table. The next thing you want to consider doing is utilizing Social Security timing to engineer tax-free withdrawals. Here's one of the most often overlooked strategies. If you retire at 62, but delay Social Security to full retirement age, or 70, you create 5 to 8 years of low income flexibility. During these years, you can withdraw from your taxable accounts tax-free up to the basis amount, realize capital gains at 0%, do low bracket Roth conversions, take small IRA withdrawals to reduce future required minimum distributions, and keep AGI low enough for ACA healthcare subsidies if they're applicable to your situation. This window is often the single greatest opportunity retirees have to create tax-free or low-tax years. And while delaying Social Security to 70 is always mathematically the best answer, it does not always make sense for everyone. If you have a shorter than average life expectancy, or you need the money to survive, you should absolutely claim earlier instead of delaying. It might make sense to beef up Roth conversions earlier and claim earlier around 65 or 66 if you find yourself in this kind of situation. The tax-free window before you claim Social Security and before required minimum distributions start is one of the biggest opportunities retirees have. Required minimum distributions will start for everyone at age 73 or 75, depending on when you're born, and they increase your taxable income for the rest of your life. The years before RMDs provide a golden planning window where Social Security may not have started, RMDs haven't kicked in, income is at its lowest point. And using this window strategically lets retirees pull from taxable accounts tax-free, do Roth conversions more tax efficiently, and realize capital gains at 0%, all while reducing future required minimum distributions so future taxes stay low. This pre-RMD period is one of the most important tax planning stages in retirement. And when used in conjunction with other charitable endeavors, such as a donor advised fund, you can really put your money to use for good causes while saving a ton on taxes. But the beauty of all 6 of the previous strategies is how all these tools end up working together within the context of your financial plan. A retiree can create tax-free income using multiple layers, utilizing Roth withdrawals, taxable basis sales, 0% capital gains harvesting, aka the pseudo-Roth strategy, qualified charitable distributions to offset required distribution, stacked deductions, and low-income conversion windows. Imagine a retiree with the following plan. Use taxable basis early to keep AGI low. Convert IRA funds to Roth up to the 12% tax bracket. Delay Social Security until full retirement age or maybe till age 70 if it makes sense for them. Then after that, use their pseudo-Roth or actual Roth for tax-free income for the rest of their life. Utilize qualified charitable distributions each year to offset required IRA withdrawals if they do still have some in traditional funds. And then finally, use donor advised funds to stack contributions for charitable giving in a given year to make better use of itemized deductions. This integrated plan can allow retirees to go multiple consecutive years paying little or no tax. I can often find ways to provide nearly $100,000 of taxable income at a 5% overall tax rate for my clients. That's the power of these strategies, and it's not an accident, it is a strategy. Let's go over a brief case study now. We have Mark and Linda who are both age 62. They have $500,000 in their taxable brokerage account, half of which is gains. They have $800,000 in their IRAs and 401ks, and $200,000 in their Roth accounts. Let's also assume that they need about $80,000 annually to live on, and that their Social Security at full retirement age is about $40,000 combined. They want to retire immediately, but delay Social Security until they convert their IRAs to Roths. Here's how I go about setting up their tax-free plan. From ages 62 to 66, we're going to focus on Roth conversions and income from taking that money from their IRA accounts by filling up the 22% tax bracket, which is roughly $206,000 of taxable income in 2025. We're going to take $80,000 to live on and convert that difference directly to the Roth account. We're going to pay taxes from the brokerage account by selling positions that are in a loss and offsetting gains elsewhere in that portfolio to have no capital gains tax application. And then they're going to owe about federal income tax of about $17,000 or $18,000 each year, which is the amount they're going to pull from their brokerage and send directly to the IRS. And the 22% bracket's really important because they can fill that up without incurring IRMA penalties on Medicare when the time comes. By age 66, they would have depleted their Roths, and through conversions and an 8% growth rate, their Roth would be worth roughly $1.2 million. And their brokerage account would be worth about $665,000. Now, what happens at age 66 or 67 and then beyond that point? Well, Social Security is going to be started by this point, and it's $40,000 in income, which is 85% taxable. Their standard deduction would be around $32,000 if it was the same as it was today. In order to have 0% capital gains tax rate, they would need to keep their taxable income below $96,700, assuming it's the same number as it was today, which means their adjusted gross income can be around $128,000. So what they can do is realize capital gains of roughly $94,000 completely tax-free after accounting for the 85% of their Social Security benefit. And we know they don't even need that much money to live on because they only need about $80,000 annually after tax. But if they did need more income after that, that is when we would start looking at Roth distributions to supplement the gain harvesting in the taxable account to continue their tax-free income plan. By age 75, they're no longer facing required minimum distributions. Their Roths would have grown to just roughly $2.1 million, and their brokerage account would be worth roughly $800,000, and most of that will be given to them completely tax-free. All of this, and they would pay almost no income tax at the federal level, roughly $1,000 annually. In addition, they could also increase their spending to enjoy life more because of the smart decision to convert to Roth to lower their lifetime tax burden during their early retirement window. And that'd be the next conversation we would have with them as a planning team. Do you want to maximize for every dollar or maximize your dollars to optimize your life rather? So what's the bottom line here? You can't control markets, interest rates, or inflation, but you can control your tax bill in retirement. And with the right strategies, you can create multi-year periods of little to no taxes while still enjoying consistent income and protecting your long-term plan. And here are the key tools you'd want to include. Roth withdrawals, taxable basis, QCDs, stacked deductions, timing your Social Security for the right point to maximize your early retirement window, pre-RMD planning, and 0% capital gains harvesting. And these strategies don't work in isolation. They're all part of a bigger machine. If you want help building a tax-free or low-tax retirement income plan that fits your situation, that's exactly what my team does here at NavWealth Partners. Reach out via the link in the description below, and we would be more than happy to help you. Thank you so much for watching, and as always, make smart money decisions.